Welcome to Sam Academy.
Hi everyone, good day. My name is Sam Akinwani, popularly called Sam. You're welcome to Sam Academy. Still on financial management. Alright, so in our previous class, we looked at investment appraisal. And of course, we looked at the definition of investment appraisal. We looked at the various methods of investment appraisal. We looked at the non-discounted cash flow and also the discounted cash flow method. So for today's class, we are looking at one of the methods under the non-discounted cash flow, which is the accounting rate of return, ARR. So for this class, we'll be looking at a few objectives. Number one, we look at when we're looking at the definition of ARR, we look at the decision rule for ARR. Of course, we look at all of the formulas included in the solving of questions related to ARR, and also, of course, we're looking at a few examples and illustrations. All right, so what exactly is ARR? Okay, ARR, which is accounting rate of return, is an accounting profit before interest on tax that is charged at the percentage rate of the capital investment. Are we together? It's called accounting rate of return. Of course, it's an accounting profit before interest or tax that is charged as a percentage of the capital invested. Okay. That is ARR. The accounting rate of return is charged as a percentage of the capital investment. Of course, is actually before the interest and tax. It's charged before the interest and tax. Alright. So we have the decision rule for ARR. What is the decision rule for ARR? Of course, while considering accounting rate of return, there is a rule. We have a particular rule that guides our decision making. Like I told us in our previous class, that investment appraiser has to do with evaluation that helps the management make decision whether or not to invest in a particular project. However, there is a body of rule that guides the decision making under ARR. So what's that decision? Now, the decision states that if the ARR, that is the accounting rate of return of the evaluated project, is higher than the minimum ARR given in the question, because all of our questions is going to be targeted or a minimum ARR accounting rate of return. So in a situation whereby the accounting rate of return, the evaluated one, the sub accounting rate of return is higher than the minimum or the targeted accounting rate of return, such projects should be embarked. Such projects should be accepted. Are we together? Of course. So after doing the evaluation, we realize that our ARR for the project in view is greater than the targeted ARR. So it's expected of the organization to accept or endorse such project. Of course, in the other hand, in a situation whereby the evaluated project has an accounting rate of return that is below the targeted or minimum rate of return, in that kind of situation, the project should not be considered, should be rejected, shouldn't be accepted. I'm clear on that now. Of course, it just has to do with the increase or a decrease in the accounting rate of return. So when you solve your question and you realize that in the question, the evaluation indeed your ARR is greater than the one given in the question, then it's expected that you accept that project. But in the situation whereby the ARR derived after the evaluation is below the one given in the question, so it is expected you do what? You reject it. Alright, so in a situation, we also have another scenario. In a situation whereby we have multiple projects, we have more than one project. Alright, so it is expected that the highest ARR, the highest accounting rate of return calculated for, are we together, should be selected. Are we together? Provided that this highest ARR is also higher than the minimum or targeted ARR. So it means that if you're having, for example, you have project A, project B, and project C. And you, of course, and the question gave you a minimum ARR of 15%. This is the minimum ARR, that is the targeted ARR. Now, after evaluation, you find out that the ARR of project A is 10%. Project B is 25%. And project C is just 5%. So the question is, which one of these should you go for? Obviously, we will surely go for project B because we realize that the accounting rate of return, the return that was generated after the calculation was 25, and 25 is higher than what we targeted, the minimum ARR. So the company has a standard, the industry has set a standard for the accounting rate of return too. There's a specification for it, so they don't want anything below 15%. So we're lucky enough to find out that one of our project evaluation is 25%. So it's expected that you go for 25%, being the highest of all of its category, and provided that it is still higher than the minimum rate of it. Are we clear? All right. So that's how you make a CE. Now for the formulas, all right, we have the formula for AR, and we have two approaches to the formula. The first approach is what we call initial investment approach. Initial investment approach. And of course, what's the formula for initial investment approach? You have your average profit over initial investment. Times 100%. Are we together? That's what the initial investment approach is. And of course, for the second approach, it's called the what? Average investment. Average investment approach. For the average investment approach, we also have a formula, and the formula is average profit. Average profit divided by average investment. Are we good? Average investment multiplied by 100%. Are we good? Okay. All right. So now, if you look at this question, in fact, all of the times your initial investments, that is the initial capital outlay, you'll be given in the question. Are we together? But there's one that won't be given in the question, is the average profit. You calculate for the average profit. And how do you calculate for the average profit? Average profit is calculated as profit before tax minus depreciation. Are we good? Profit before tax minus depreciation. Or some of the times whereby you have multiple projects to be undertaken, how do you calculate it? Add all of the profit of the project, are we together? After deducting your depreciation, then divide it by the number of the project. By the time we start solving exams, you see what I'm talking about. All right. Of course, the average investment also is not always given. So there's a formula to intervene. So for the average investment, how do we calculate for it? So you have what? Cost plus scrap value divided by 2. Are we good? That's the formula for average investment. And of course, by the time we start solving examples, we see the application of all of this formula. And of course, it's very important to know that the most tested or the most preferred approach is the average investment approach. You barely see questions on the initial investment approach, of course. They will always ask you to make use of the average investment approach, only if it is stated or otherwise in the question. Is that okay? Alright, so let's solve the question. So this is the question on accounting rate of return. Value Limited is considering a project that requires an investment of 1,200,000 naira. The project is expected to last for 5 years. An expected scrap value of 400,000 naira. The annual profits before depreciation is 240,000 naira. So the company require a minimum accounting rate of return AR of 15% required should the project be undertaken. All right. So I've told us in the previous class that we have a formula for ARR, and which the formula is average profit over average investment. Like I told us, an average investment approach is the most popular and, of course, the most prevalent of the two approaches. All right. So solving this question, if you look at the question told us that the annual profit before depreciation is 240,000 naira, which means that depreciation, you know, which means that depreciation has not been charged. All right. So the first thing we have to do in this question is to charge our depreciation. All right. In our days back in secondary school, under depreciation, we all know that depreciation has several methods, and of course, for this particular situation, we are going to be using a straight line method of charging depreciation. All right. Solution. So the first thing you write is the name of the organization of valor. So what are we solving? Depreciation. So using the straight line method, what's the formula for depreciation? Depreciation is cost minus value over a number of years. We call it useful life. So considering this question, what's the cost? It said value limited is considering a project that requires an investment of 1,200,000. That's the initial cost. So our cost here is 1,200,000 minus the scrap value. If you look at the question, the went further and said the project is expected to last for 5 years and expected scrap value of what? 400,000. So our scrap value is 400,000. So divided by what's our useful life? That's the number of years. They said the project is expected to last for what? 5 years. 5 years. So when it comes to the piece of a calculator, if you punch the face of the calculator, it's fine. You have 1,200,000 minus 400,000 divided by the 5 years. So that gives you 160,000. 160,000. Our depreciation is 160,000 naira. All right. So now that we have found our depreciation, so the next thing we are going to solve for is our average profit, our annual average profit. Now, if you look at this question now, this question doesn't have series of projects. We only have one project, so we are considering one profit. The question has been to us. So, in order to find our average profit, so we call it annual average profit. Annual average profit. How do you find your annual average profit? Your annual average profit is profits before depreciation minus depreciation itself. The depreciation that you just saw. So look at the question. What's our profit before depreciation? It says the annual profit before depreciation is what? 240,000. So our annual profit is 240,000 naira minus our depreciation is what? 160,000. So our annual profit would equals that should be 80. That should be 80. So we have 240,000 minus 160. That's a nice 80,000. 80,000 naira. So now that we have solved for our annual average profit, the next thing you solve for is your average investment. Average. In our in our introduction to ARR, I gave us the formulas. And the formula for average investment is what? Cost plus residual value, which is also scrap value, divided by 2. So if you look at the question, what's our question? Our initial cost said is considering an investment of 1.2 million rand. So our residual value is 1,200,000 rand. Our cost rather, if that's our cost. That's our cost. 1,200,000 plus our residual value. So what's the residual value? That's the scrap value, right? An expected scrap value of 400,000. 400,000 divided by 2. So what do we have as a figure? So 1,200,000 plus 400,000. That gives you 1,600,000. 1,600,000 divided by 2. So what does it give us? So if you divide 1,600,000 by 2, what will you have? Of course, we have 800,000. 800,000. So our average investment here is 800,000. Now we have to solve for our ARR. That is the accounting rate of return for this particular period. So what's the formula for ARR? ARR, like I said, is equals to what? Average profit over average investment. Times 100%. Alright. So what are average profits? Looking at the question, these are average profits. 80,000 divided by what's our average investment we just of 800,000. 800,000 times 100%. So what do you have? That's gonna give you 10%. 10%. Are we good? So when you punch the face of the calculator this way, you have 10%. Now that we have gotten our ARR after evaluation on this particular project that Valor Limited is, planning to embark on, and we realize that we have an ARR of 10%. So the question now says, should the project be undertaken? Now, in the previous shorts, I told us that in order to make a decision, the decision rule for accounting rate of return is based on the expected, is based on the calculated ARR. So when you look at your calculated ARR, in a situation whereby your calculated ARR is greater than the minimum ARR, then you accept it. But in this situation, reverse is the case. Our calculated ARR, which is 10%, is lesser than 15%. So in this situation, what do? You won't accept the project, so you reject the project. So your decision. You can just manage to write your decision. Calculated ARR of 10% is lesser than 15, lesser than minimum ARR of 15%. Therefore, projects should not be accepted. So now we're going to be looking at another example, and of course that example is where we have instances or scenarios where we have
various projects, more than one project.